Today, we're diving into an investment strategy that, until recently, was pretty much only for the super wealthy. It's called direct indexing, and it is completely changing the game for how people build and manage their money. We're going to break down exactly how it works. So let's just kick things off with this bombshell of a quote. For decades, ETFs, exchange-traded funds, have been the absolute go-to for smart passive investing. But now, for a certain type of investor, they're considered dead. Why on earth would anyone say that? And that really gets to the heart of what we're talking about today. What is this strategy that billionaires are using? And just to be clear, we're not talking about some shady back alley loophole. This is a totally legal, structural advantage that's only now possible because of technology. It's something that just completely rewrites the rules of investing. Okay, so to really get this secret, we first have to look at how most of us invest our money right now. Because there's a hidden limitation inside the most popular investment products that most of us never even think about. Right. So when you buy a share of an S&P 500 ETF, you might think you own a little piece of Apple, a little piece of Microsoft, and so on. But you don't. You actually own just one thing, a share of the fund. It's like a wrapper that holds all those stocks together in one big pool. Now, for most people, this is great. It's super simple and efficient. But for some, that wrapper is kind of a cage. And that cage, well, it has a hidden flaw, a big one, especially when you start talking about taxes and customizing your portfolio. Let's really dig into what that flaw is. Okay, so this right here is the whole ballgame. On the left, you've got the ETF investor. You own one thing, the fund. That's it. You're just along for the ride of its overall performance. But look at the right, the direct index investor owns all 500 plus individual stocks directly. That one little change, that ownership structure, unlocks everything. Suddenly, you can manage every single stock on its own, and that is the key to some incredibly powerful tax-saving moves. So the big idea is to just get rid of that wrapper. You unwrap your investments so you can actually hold all the individual ingredients yourself. And this whole strategy has a name: direct indexing. So here it is, plain and simple. With direct indexing, you're not buying a fund that tracks the S&P 500. Nope, you are literally buying all 500 stocks in the right amounts, right in your own account. And here's the crucial part. You use some really smart software to manage it all, so your portfolio acts just like the index. But now, you're in control. And once you have that control, you can fire up what's known as a tax alpha engine. Honestly, this is the #1 reason the ultra-rich fell in love with this strategy. So what in the world is tax alpha? You can think of it as a bonus return on your investments. It has nothing to do with picking winning stocks or timing the market. It's all about using smart tax strategies to boost your after-tax gains, no matter what the market is doing. Let's make this real. Imagine the S&P 500 has a fantastic year, right? It's up 15%. If you own the ETF, you're thrilled. Your investment is up 15%. Easy, but there's a whole other story happening underneath that big, shiny number. And here is that hidden story. You see, even in a monster year where the index is up 15%, not every single stock went up with it. In this example, 30% of the companies in the index actually lost value. Now, if you own the ETF, there's nothing you can do about that. But if you're a direct index investor, you see this and you see a massive opportunity. And this is how they grab that opportunity. It's a process called tax loss harvesting. Basically, an algorithm is constantly scanning your portfolio every single day. The moment it spots a stock that's down, it sells it. Why? To harvest that loss for tax purposes. You can then use that loss to cancel out or offset capital gains you might have somewhere else. Then, and this is key, the software immediately reinvests that cash into a really similar company, a proxy stock, so you never lose your spot in the market. It's this continuous automated cycle of optimization. But listen, generating those tax savings is only half the fun. Once you own the individual stocks, you're not just a passenger on the index train anymore, you're the one driving. You can literally build an index that follows your own rules. So check this out. Let's say you're a tech exec and you already own millions of dollars in Apple stock from your job. The absolute last thing you need is to buy an S&P 500 fund and accidentally buy even more Apple stock. Well, with direct indexing, you can just tell the software, hey, buy me the S&P 500, but leave out Apple. Just like that, you avoid piling on more risk. You just can't do that with a normal ETF. And that same logic works for investing based on your personal values. Instead of buying some prepackaged green fund that's based on someone else's definition of what's good, you can build your own. You just start with the whole index and tell the algorithm what to kick out. Maybe it's fossil fuel companies, maybe it's private prisons, whatever it is you don't want to support. The software then just rebalances everything else to keep you tracking the market. It's total personalization. Now, this level of control, this optimization, it sounds like science fiction, but it's really happening right now. Which leads to the obvious question. Why now? What changed to make all this possible?
Well, it was basically a perfect storm of technology. First, zero commission trading made all that frequent buying and selling for tax loss harvesting totally free. Then, fractional shares came along, which meant you didn't need millions of dollars to actually own all 500 stocks. And finally, the algorithms just got so powerful they could handle all the complicated math in the blink of an eye. Those three things together just blew the doors wide open for direct indexing.
You know, when you step back, what we're really seeing is a huge shift from investing in a product, like an ETF, to investing on a platform. It's basically the difference between buying a CD at a record store and using Spotify. One is this static, prepackaged thing made for everybody. The other is a dynamic, customizable platform that builds the experience just for you.
And that leaves us with one last, pretty fascinating question. For decades, the holy grail of investing was to own the market as cheaply as you could with an ETF. But as the tech behind direct indexing gets cheaper and more available, the whole goal might be changing. Now, of course, this level of personalization comes with platform fees that ETFs don't have, so the real question is, at what point do the amazing benefits of tax savings and customization start to outweigh those costs for the average person? Are we headed for a future where we all expect to not just track an index, but to truly own it and make it uniquely ours?